Hi, Isabelle. How are you?
I'm very good, thank you.
Thank you for joining us. In the last few weeks, we observe a major increase in the equity markets. What is the role of central banks in this? I mean, how did their actions contribute to the rally that we've seen?
Sure. Well, first of all, I would like to clarify that markets have actually been going sideways in the last few weeks, but it's true that there's been a major rally since the trough that was reached in March at the peak of the epidemic. And some markets are already back higher, like the Nasdaq, for example, is higher than before that trough. Other markets have recovered substantially. And yes, indeed, this is in large part thanks to the very massive policy response that we've seen all over the world. And central banks have been a key actor in that policy response. For sure, not the only one, but they've been in part playing a very important role in that policy response and therefore in the recovery in all risk assets, including stock market.
So far, how much money flowed from central banks to the financial system?
Yes, so that's a good question, but equally one needs to be careful not to add apple and oranges. Overall, we're talking several trillion worth of US dollars, taking different forms between asset purchases, liquidity providing through the banking system, the BIS, which is, as you know, the central bank of central banks, so to speak, expects central bank balance sheets to increase by at least around 20% for the G5 countries, for the largest five economies by the end of the year. So we're talking massive amount of liquidity injections. And in fact, we've already seen more in the last few months than during the entirety of the global financial crisis.
Actually, we've seen that central banks began to buy not only government bonds, but also corporate bonds and other assets. Do you see any difference about the role that central banks play today in this crisis comparing to the global financial crisis of 2008?
Well, yes, of course, they're playing a different role because it's a very different crisis. Back then, what we were dealing with was a financial sector crisis. This time, the financial sector had nothing to do with it. We had a shutdown of economies mandated by governments. And so you had a two-part response. You had the fiscal authorities splashing out, if you will, spending to try and substitute for the lost income by households and corporates. And at the same time, you had the central banks stepping into financial markets, both to, and primarily initially to ensure that they kept functioning. And that's really what pushed the Federal Reserve and other central banks that hadn't been used to buying corporate bonds. The ECB had been doing that for some time. But in the United States, in Israel, and other countries where the central bank steps into corporate bond markets, it was really to ensure proper market functioning. So that was a key driver of these central bank interventions, keep markets functioning to avoid adding additional stress into the economy at that time. And then, of course, the other big part of these liquidity injections have been in the form of purchasing government bonds, which effectively allowed governments to do massive amounts of additional issuance, again, without clogging up the markets, without triggering a major tightening of financial conditions.
Do you think it's dangerous as well?
At the current juncture, I think it's not doing it that would have been dangerous. If the central banks had not deployed their balance sheets in the aggressive and massive way that they have, I think we would have seen a complete freeze or seizing up of financial markets globally. And so it's really inaction that would have been dangerous. Now, obviously, there's a question of what's going to be the exit strategy. How do we get out of this current regime? And clearly, if it goes on for too long, there may be dangerous characteristics to this process. In particular, a form of complacency around issuance of additional debt and potentially down the road even inflationary concerns if some central banks that had acquired a lot of independence and credibility over the years find themselves under the thumb of their governments and pressured into continuing to buy government debt, etc., and injecting liquidity when it's no longer warranted. So it is entirely possible that down the road, not anytime soon, but down the road, inflation concerns, credibility concerns about central bank independence may surface. But I would say this is really not an issue at the time being.
Nowadays, we observe very low inflation levels. In your opinion, how long it will remain?
So that will depend very much on what happens to the economy. Under the baseline scenario where there is no resurgence of the epidemic that causes further shutdowns, we do expect a fairly strong recovery in the second half of this year and going forward. And even under the more pessimistic forecasts, such as the one issued by the IMF yesterday, for example, the International Monetary Fund, you would still see the U.S. recover its December 2019 level of GDP by early 2022. Most emerging markets a little ahead of that. The rest of advanced markets, soon thereafter. So until we're back at that level of activity, frankly, it's very hard to think that there would be significant inflationary pressures. Beyond that, it's more of an open question.
So when can we expect to see interest rate hike in developed countries?
Not for a very long time, I would expect. Not for a very long time, because, and if anything, the risks are more tilted to the downside in terms of an additional shock to the economy coming from a resurgence of the pandemic. And if that happens, then most central banks have said this additional rate cuts is something they would need to consider. So, you heard, I'm sure, Jerome Powell at his last press conference a few weeks ago saying, we're not even thinking about raising rates. And I suspect this is very much the mindset of most central bankers out there. And so, likely we're talking well over a year before we're seeing any interest rate rise.
So does central banks have more tools to handle the crisis we are in right now?
I think that's right. I mean, what's interesting is that, before the COVID pandemic struck, there were a lot of discussions among market commentators along the lines that central banks were out of ammunition, that they didn't have anything left in the toolkit. And central banks have proved beautifully and massively that that was not the case, and that there's always more tools. And you can also use the ones that you have to a greater extent than you did in the past. And in fact, this is exactly what we've seen. More rate cuts, more asset purchases, new types of assets, as well as, in a number of cases, frankly, unprecedented effort to push liquidity down through what the BIS head, Agustin Carstens, calls the last mile. And that is by, going direct, trying to put money directly into the pocket of municipalities, small and medium enterprises, and even in some cases households. And because of that, we've seen a real blurring of the limits between monetary and fiscal policy, which again was very necessary in this case, probably, but carries dangers down the road in terms of how do you unwind that.
Do you believe we might see a change in the policy after the elections in the USA?
Well, I think we'll see changes in policies just because we do expect the economy to recover and the pandemic at some point to dissipate. So with or without an election, we would need to see changes, particularly on the fiscal side. The degree of fiscal support that has been expended cannot carry on forever. But of course, the election, opposes two very different visions of economic policy. And so if there is a change in administration, we should expect indeed to see some policy changes, particularly in terms of how the burden of paying for all this extra spending is distributed between households and corporates in particular.
And do you think that the relative strength of currencies will play any major role in the recovery of different countries?
So far, that hasn't been very much of an issue. I mean, for one thing, advanced countries don't target any particular level of their exchange rate. They just run monetary policy and then let the exchange rate do whatever it may. I think in emerging markets, there's been, in general, a kind of generalized weakening of emerging market currencies. And so, of course, the countries that have been the exceptions, that have been seen as safe haven, and certainly Israel is one of them, has seen appreciation pressures on the currency. And quite sensibly, the central bank has decided to intervene to counter that appreciation in order that it doesn't hurt the recovery prospects. And I suspect that among emerging markets, as we see some of them recover, get out of the pandemic much faster than others, they are likely to attract capital inflows faster or sooner than the others. And this could have implications in terms of currency appreciations. And yes, I fully expect that there will be efforts to slow down this currency appreciation in order to avoid hurting the growth prospect.
Isabelle, thank you very much for joining us.
My pleasure.